Let me jump in. On behalf of Connecticut Economic Development Association, CEDAS, welcome to our second educational program for 2023. We're excited to jump this off. My name is Paige Bronk. I'm the president of CEDAS. Also, I'm joined with Kevin Bielmeyer, who is the CEDAS first vice president, who will lead today's program, which is focused on tools, trends, and techniques, an industry overview. I think my role at this point, I want to give you a few comments about CEDAS. CEDAS is a not-for-profit membership organization committed to advancing the practices and process of economic development, specifically in Connecticut. CEDAS has approximately 200 members from municipal, state, regional, private, and educational sectors. Our objectives at CEDAS are to provide a forum for the economic development community, sponsor educational programs, facilitate communication among partners and members, network, foster sustainable economic growth in Connecticut, and also prepare and support necessary legislation to improve Connecticut's economy. At this point, I'll hand off the program to Kevin to facilitate today's program. Thanks, Kevin.
Thank you, Paige. We're real pleased to kick off our 3 T's webinar series, Tools, Trends, and Techniques. Our first session of this is an industry overview by Mike Goman of Goman in York, a man that needs really no introduction for the majority of you, but I'll do so nonetheless. Mike is the Principal and Advisory and Development Services lead for Goman in York. He has more than 40 years in the real estate industry. He advises municipalities, tenants, corporations, institutional investors, and high net worth individuals regarding commercial real estate investment, acquisition, and development. Mike also serves as the president of AccuBranch LLC, a provider of real estate market research, strategic network planning, and the branch program implementation service to regional and community banks. He's a licensed real estate broker in 5 states, certified leasing specialist, certified retail property executive by the International Council of Shopping Centers. And Mike was named 2021 Realtor of the Year by the Greater Hartford Association of Realtors. So without further ado, let me hand over the program to Mike Goman.
And thanks, Kevin, and thanks, Paige. Nice to see everyone. I'm glad to be here again with you this afternoon. I'm going to jump sort of right into the presentation, if that'll work here, if I can get the technology to do what we need to. Is that good there? We got the deck?
We got the deck up there, Mike, and I just want to add to everyone, we are going to save questions and answers to the end because we do have a lot to get through.
And the deck will be available if anybody wants it. You can contact CEDAS, and they have a copy of it, and we'll be happy to send it out to you. And if you have any follow-up questions, please just reach out to me. So let's go right into it. The changing landscape. That's appropriate for the times that we're in. I'm not going to cover that. Kevin already did. I saw this headline just recently in the Wall Street Journal, and it struck me as sort of indicative of what's going on within our world. It seems like everything is upside down, and what we knew to be true a few years ago is no longer true. And when I saw the headline and it said the Earth's core may be reversing rotation, I thought, well, why not? I mean, everything else has gone crazy, so I suppose that makes sense. So let's dive into the sector update very quickly here. And I've started off by saying it's a real shift in demand. Many of you are seeing a decline and have seen a decline in the occupancy levels, utilization levels of your office space. The latest data is still showing that most central business district office areas are 50%, give or take, occupied. Some are still down in the 30s. There are a few that are up in the 60s, but still well short of being typical historical occupancy levels. We think work from home is going to continue, and we don't know what normal is going to look like. We probably won't have a sense of what that'll be until 24, another year from now. The impact of that is huge. There's roughly just as an example here, just the office-backed mortgage bonds in New York City are $17 billion in real estate value. And what the long-term impacts of these lower levels of occupancy and therefore lower levels of demand are going to have on the value of these offices has yet to be seen, but it's not good. I mean, we'll talk about that a little in a little more detail. The long-term impact is definitely going to be negative. What will change work from home? If the unemployment levels start to go up and jobs get harder to find, companies will be in a better position to require people to be back in the office. And of course, competition pressures on companies, and we're seeing a little of this already, where the management of the companies is saying, look, we can be more competitive if we have everybody in our office day in and day out. So we're starting to hear sort of anecdotal evidence of companies pushing people to spend more time in the office. Also in the office segment, there's a lot of price discovery is going on still, huge gaps between what sellers and buyers think something is worth, and we don't see that narrowing for a while, probably until some of these issues kind of work their way through the system and we have a sense of what normal is going to look like. We spend a lot of time looking at building utilization versus just vacancy. Vacancy tends to be referring to what's leased and what's not leased. The problem with that data now is the building could be economically, 80 or 90% leased, but only being 30 or 40% utilized. So utilization rates as a metric has really become central to everything that many of us are doing in the industry. Retail's recovering, had a pretty good year last year, up about 6.5%. And when we talk about retail, we're excluding things like cars and the sale of gasoline and so on. We're looking at purely sort of merchandise sales. The holiday season was a little off, wasn't as robust as expected, but still ended up with about a 5.3% increase. Online retail has really leveled off. It was growing at a pretty fast rate, as you'd expect during the pandemic, but it's really slowed down now. And all of the surveys that are being done out there are clearly showing that shoppers still like going into physical stores. When that question is asked in surveys, a little over 2/3 are responding that given the choice, they want to be in a physical store. Inflation is taking a toll, particularly on sort of discretionary spending. The focus is more on commodity, necessities and so on. And we're seeing people trading down away from private brands into store brands and so on, things that are a little cheaper price points, and that'll probably continue. If you've listened to this overview presentation before, you've seen this slide, but it's still relevant. There is roughly about 2,000 centers over 400,000 square feet that are considered Class C or worse. Some of you have these in your communities, and they're still going to be a problem. I mean, many of them are going to have to be something else or go away. We expanded our data to look at open air strip shopping centers less than 200,000 square feet. And those numbers are, depending on where you place your markers, between about 12 and 15,000 of those across the nation. And again, some of you have 1960s and 1970s vintage versions of 100 to 200,000 square foot strip shopping centers that are in really tough shape. So those aren't in these numbers. Those are over and above. And the point is that, again, a lot of those are going to have to go away and become something else at some point. And communities are going to have to be a little proactive to make that reconfiguration, redevelopment happen. Otherwise, the community is going to be sitting there looking at it for some extended period of time. Restaurants, a lot of closings through COVID. The casual dining and local guys got hit the hardest. Local guys typically because they have low liquidity and find it hard to survive. There was a ARPA plan to help them, but that ran out pretty early. And we've seen a lot of closings of local restaurants that have been in business sometimes for decades, unfortunately. Casual dining has just recently, since the new year, started to show higher traffic levels and is starting to recover. That's the Chili's, Applebee's kind of category of sit-down restaurant. And they really got hit hard because people just didn't want to be in proximity to each other the way those store formats are set up. But that's changing, and they're now starting to see increased traffic levels, which is a good thing. Still facing increased costs and staffing shortages. We're responding to those with smaller, reduced operating hours, but the rate of closures has stabilized. We are seeing some expansion in the quick service or fast food area. We're going to talk about that in a few minutes, but starting to recover. People very much moved to the drive-through lanes during COVID for obvious reasons, and that seems to be continuing to be the case. So the industry is responding the way you'd guess. Hotels, traffic has come back pretty well. We're up to about 95% of the 2019 levels. The interesting point is and we've seen this for a number of years now, but the millennial group is not the shopping group that the baby boomers were. They are much more inclined to spend money on travel and hotel stays and so on than they are to be shopping in your local mall, which is a problem, but it is what it is. But we're seeing that. We're going to talk a little bit more about what the millennial group is up to in a minute here. But definitely coming back to pre-pandemic levels. The recovery is being led by the tourists, resort community. People just want to be out into the sunshine and have vacation with their family and friends and so on. Makes sense. What has not recovered yet is business travel, that sort of highway interchange, roadside hotel for the salesperson that's on the road. That hasn't come back fully yet, and we don't think it will until next year. Conventions are starting to come back, but that's a long lead time because they have to book them so far in advance. But that is showing signs of coming back. So we think we'll start to see convention center hotels recover probably beginning this fall. A lot of extended stay activity, and that's partly because of work from home. People are traveling but continuing to work while they're traveling, and they want that extended stay environment where they can sit at a desk and work while they're in Oregon or wherever they might want to be. And so they extended stay hotels have enjoyed unusually high occupancy levels. Hotels are dealing with the same understaffing issues and that retailers and restaurants have been faced with. Interesting data point on the hospitality side is also the degree to which the mobile app usage has really gone up dramatically. And we're now seeing that reservations, about 2/3 of reservations are being made off of an app on a phone. The phone is also, of course, being used for access to the rooms. So you don't even have to talk to anybody at the front desk when you're on your way in. You can get your digital key and use your phone to open up your room. So long as this work from home continues, we're going to see this blended travel, what's referred to as sort of digital nomads, people that just travel around the world and continue to working from home, but sort of mixing it up with resort travel or sort of vacation oriented or experiential travel. Another interesting data point in this sector is the projections for the compound annual growth rate through 2031 being over 8%. So expected to be a very robust sector going forward. And I think that's going to drive the development of new hotel properties in a lot of markets. And I think that'll be likely to be a permanent addition to the industry going forward. Just to sort of touch base again, many of you are very familiar with this kind of data, but when we say millennials, we're talking about those between 23 and 38 or born between 81 and 96. You'll see different metrics used for millennials and some of the other generations that are referred to, but this is the one that we think is the most accurate, most relevant. So when we're talking about millennials, we're talking about those from 81 to 96. So just to touch on residential for a minute, single family definitely things cooling off in some of the, especially in some of the overheated markets. Supply, though, in markets here in Connecticut particularly, continues to be constrained. The time on market, it's going up, but it's still very low by historic standards. We are seeing a little bit more balance returning between the buyer and the seller, although we just saw some data recently about a couple of markets here in Connecticut that are still showing, houses being sold well over ask with 30 offers in 2 days and so on. So I think, we're in a bit of an unusual situation here in Connecticut in that regard versus a lot of the high growth Sunbelt markets that we look at in that regard. Interest rates certainly are driving up the cost of owning a house, and the impact of that is slowing down demand and bringing prices down definitely. Point out that over the past 40-year period, the average mortgage rate 7%. So the numbers we're seeing now aren't, they feel very high. If you've been recently, if you're coming into the industry, it's been relatively recent, but if you've been in it as long as many of you on the phone here, on the call here, have been in it, when rates dropped below 10%, we thought money was free at that time. The first commercial project I did in early 1981, our construction loan was 23%. So when you talk about rates being really high at 7 or 7.5%, I just have to kind of take a breath and say, well, the key to these rates is always the spread, not the rate really. But there is a temporary adjustment period as rates go up. The BFR business, the build for rent business, it slowed down a little bit, but we think that's temporary. It has shown robust growth. You can see 2019, 56,000 units up to 119. And the projection is to go by 2027 to 188,000 units. So substantial growth expected in that business. And again, as you might expect, much of that growth is in the Southeastern or Sunbelt markets. Back to the millennials for a minute. There's roughly 83 million millennials that are sort of aging out of apartments, and they will come into the single family residential market in the coming years. So we are currently doing some research on what that's likely to mean both to the apartment sector and to the SFR, the single family residential sector. The millennials delayed buying homes primarily as a result of college debt and economic uncertainty and so on. But we think they'll return to historic norms of home ownership, and the impact of that and how quickly they come into the market is going to have a big impact on single family residential. Multifamily, at least in the foreseeable future, it's still very much in favor. We've got a typo here. Rents and rent growth definitely showing some volatility and some weakness, but it is, again, very market specific. Some of the Sunbelt markets that have had enormous increases in apartments are definitely showing signs of weakness. The occupancy levels are dropping, the incentives they're offering, free months and so on, are increasing dramatically. We're really not seeing much of that in new product here in Connecticut yet. And I'm not sure, given the slower pace at which things tend to occur here, I'm not sure we will see much of that. I think if anything, we're expecting to see a slowdown in the rate of growth, the rate of rental growth, but not really a lot of weakness or volatility in it. The impact on development is really driven by these factors: inflation and economic uncertainty and interest rate and cost increases. But we are seeing this definitely leveling off of rent growth here in Connecticut. And that's an issue because a lot of the apartment projects that we've done the feasibility studies on for the last few years, a lot of the internal rates of return really depended upon significant increases in rent each year. And if you change that rate of increase in annual rent from 5 to 8% to 2%, that makes a big difference in the 10-year IRR calculations. And we're definitely seeing that here in Connecticut. So something to be looking at if you're looking at a proposed project. If you see developers still assuming they're going to get 5 to 8% rental increases, and it appears that that's what's driving the project, the internal rates of return of the project, that's something to be a little careful about. Financing has definitely become harder to find in this sector. Loan to values have dropped from, high 90s in many cases, down to 50 and 60% of loan to value. That means a lot more equity has to come in. And other metrics like debt service coverage and so on have jumped dramatically as well, just making it harder to find. There's also a flight to quality and the best markets, the strongest markets. And I think we'll probably see that continue for the foreseeable future. Self-storage seems to continue to be on a roll. We're seeing steady growth in self-storage, a lot of growth in climate controlled storage in the last 8 months to 9 months. There is a new sort of segment within this sector that they're referring to as luxury self-storage. And that essentially means where you can drive your car right inside the building inside, the interior doesn't look like a warehouse. It looks like a high-end car showroom with a epoxied floor and all kinds of light. And you can unload and, it's all climate controlled, nice elevators, and the exterior of those buildings looks like an office building. If you drove by it, you would never realize it's self-storage. So we're seeing that develop and I've been in a few of these projects in the South, and they're pretty interesting. We haven't seen one up here yet, but we will. Warehouse and logistics, strong, very strong demand. A little bit of deceleration again in a few markets, and again, mostly in those markets which were pretty frothy. They got overbuilt. But the vacancy continues to be hovering around 4%. And that means that we'll continue to see development. Definitely market specific and being impacted by the other things like cost increases and interest rates. But in the third quarter of 22, we were tracking over 600 million square feet of new construction nationwide in warehouse. Well, that number is almost 1 billion now square feet nationwide. There are some markets that are, some regions that are building 150 million square feet in the next year, just on their own, one single region. So huge developments still going on in that. This slide, I can't remember if last time we got together, we had this slide we updated every month or so. This is just the sort of north of Hartford region. It doesn't include Hartford, just Windsor and up north to Springfield and so on. Just shows you some of the warehouse logistics properties between 100,000 and right up to over 3 million square feet that have been developed in the last year or two. What are we watching? Continuing to watch the casual and local dining for reasons I mentioned earlier, and central business district and suburban office, especially the older stuff, 1980s, 1990s vintage or earlier office buildings, especially if they were a sea of cubicles and not divided up into smaller spaces. As those tenants' leases come up, the tenants are moving out and moving into smaller space typically and leaving behind very large amounts of open office space in a lot of markets. And from a municipal standpoint, this is something that everybody needs to be watching because it's really going to have a dramatic impact on the value of that office sector within your municipality. And if you're looking at it, just pay particular attention to things that are above 40 years old. At 20 years old, an office building needs a roof and a parking lot refresh. But when they get to be 40, 50, and 60 years old, now you're replacing windows and you're replacing mechanical, electrical, and plumbing systems and so on, life safety and all kinds of things. So you're really dealing with a shell building at that point that needs to be renovated to bring it up to modern standards, and that gets really expensive. Probably we looked at a project the other day, it was $150 to $180 a square foot to bring it back online in an office building, and that they used to build them for less than that. So it's a big issue going forward. So, what brought this on? Much of this really began in the 1990s when we began to have just simply too much retail and office square footage in many of our markets. And we also started to see underinvestment in existing assets as vacancy rates started to climb and rents started to flatten out or decline. Some of those properties that came into the 90s already being a little bit older were already in trouble. They just got worse, and the properties built in the 80s and 90s that are now approaching 40 or 30 or 40 years old or more are just getting tougher and tougher. So COVID made it all worse with the growth in online utilization and going forward, this issue of work from home is here to stay with us for the foreseeable future. So we're going to continue to see, as I mentioned earlier, some real market corrections in asset values and so on that'll happen. We often get asked about interest rate increases. Definitely think that they're going to continue to go up. Hard to read what the Fed is thinking about it on any given day. The last week or two, there's been signals saying that they're going to go after interest rates as a way of slowing down inflation again more aggressively than they were thinking about a month ago. I guess we'll just have to see. When we do our projections, we're factoring in rates now up in the 8s and 9s. And, who knows, we might find ourselves over 10 at some point. But right now our low is in the low 7s and our high is in the mid 9s. And our median sort of rate right now that we're using is 8. And I think that'll continue until we see some indication from the Fed. We think this bid-ask spread that I referred to earlier, they always close up. We see this in other cycles. We've seen it in other cycles, and it eventually closes up. Sellers particularly become more realistic. Buyers don't want to sit on the sidelines forever, so they start to come into the market, and that will definitely close the gap. We will see cap rates continue to rise, though, as they always do, in lockstep somewhat with interest rates. Mentioned financing criteria tightening earlier. We're already seeing an increase in defaults and foreclosures. Brookfield, one of the largest office building owners in the world, just gave back 2 major office buildings in downtown Los Angeles. I mean, that's a sentence I never thought I would be saying, where Brookfield is handing back Class A office properties in downtown LA. I mean, that's just a game changer, or whatever you want to use as a term, but it's pretty dramatic, and it's not going to change for the foreseeable future. It's impacting all markets, and office is simply going to continue to suffer for the foreseeable future. Both office in suburban settings. It's not just a CBD issue, it's definitely in suburban settings as well. This is a little excerpt from something that we looked at. We started to think internally here about the impact of work from home on the largest landlord in the US, which is the government. So we looked at some of the data available from the GSA, the federal government, on what they lease and own and so on. And we started to play with some of the numbers, if they were giving back 50% of it, for example, or 40% or 30%. Anyway, this is some rough data, roughly just a little under 8,000 leases, 180 million square feet, about 5.7 billion in annual rent, 19,500 buildings that they own, and over 500, covering over 511 million square feet of office space. So the real estate roundtable picked up on this, and they wrote a letter to the GSA, and this is an excerpt from that letter. And you can see what it's saying, that as of March last year, more than half of the GSA's leases, covering 88 million square feet, have expiration dates before 2026. So the question from the real estate roundtable to the GSA was essentially, what are you going to do? The landlords are all, landlords that have the GSA as tenants typically felt that they were bulletproof. It's almost a bond, and that's no longer the case. So the question for the real estate roundtable of the GSA was, what are you going to do? And they, in the letter, they go on to say, look, the impact of reducing your footprint in communities around the nation could change the economic balance, if you will, within the community. And it's, we tend to think of this as a DC issue, but it's not. The feds have offices all across the country, large and small. And if they start giving back a quarter of that space, it's going to have a dramatic impact. So if you have a federal office in your community of any size, give that some thought. And so continuing along with questions we get asked, what's this likely to look at? Are we going to be faced with a recession? And so far, anyway, we're saying we don't think it's going to be a hard recession as it's typically defined, but more a short and shallow slowdown, probably a soft landing. That we will continue to see growth in Sunbelt markets in many of the sectors, with the exception of a couple I've mentioned here. Certainly headwinds with the market uncertainty and costs, volatility and so on, and the flight to quality. There are reasons to be concerned. Roughly 28% of the collateralized mortgage-backed securities, about $5.5 billion, are in a situation of what we call negative leverage, where the debt is greater than the value. Interestingly enough, a big amount of that is in older storage facilities and older multifamily rental residential facilities. But there's some big numbers out there that we're concerned about as to what the impact of all this long-term is going to be. Hiring within the industry, the real estate industry, is way off. We're seeing even large companies like CB Richard Ellis unload staff. Definitely lower rents and more terms, more flexible terms. And the availability of properties has narrowed, except for in the B and C properties. There's a lot of people trying to unload B and C properties now. The difficulty of refinancing, that'll continue for the foreseeable future in light of some of these changes to the rental income, meaning that it's either flattening out or declining. Of course, appraised values are following that trend, and there's this flight to quality to A markets and so on. Leases are definitely getting tougher, except in the best markets. And without population growth, most Connecticut markets fall into that category. We're having very low to no population growth. We shouldn't be expecting any retail or office of any scale to occur. There's just simply no tenants for it, and no money to finance it. So no surprise there. The retail and office sectors are just in tough shape. There should be a lot of focus going forward on this conversion. We're seeing it. I can't say that we've seen any real strong emerging trend. It seems to be all over the place. Retail and office is being redeveloped across the sectors. Hotel, changing it to hotel, or residential, or self-storage, or logistics, all kinds of things. So I think it's, again, typically, as you'd expect, it's market by market. There is more interest in suburban development opportunities of all types, and lower interest in urban. And that's because of this work from home. We use a lot of services, a number of services, some of which you've probably seen, like Placer AI, that track mobile traffic. And the interesting thing about that is you used to be able to look at that data and say, here's the work from home pattern. I can see traffic leaving their houses and going into the central business district in the morning, returning at night. Those traffic patterns have all been upended. We're just not seeing that. A lot of times the traffic levels, morning drive time, afternoon drive time, are confined to within a suburban market. So changing those patterns really sort of upends the analysis of values and what's likely to happen with different properties in different sectors. We're definitely seeing projects falling victim to this. I've mentioned a few of them, and we're going to see that continue. Building designs will continue to change. We're definitely seeing a move towards more flexibility and sort of open air, very flexible space where desks and seating areas and meeting areas can be moved around at will. Definitely more horizontal mixed use as opposed to vertical mixed use. And part of that is going to be, going forward, will be driven by the availability of buildings at very low prices in a suburban setting, where they're single-story buildings or two-story, three-story buildings. And we're going to see a lot of those kinds of conversions on that type of property. A lot of emphasis on building technology around these issues, security and health and environmental and so on. We think specialty retail was going to see very anemic growth. It has been relatively anemic for the last number of quarters, and I think we'll continue to see that. That's regional mall tenancies typically. We mentioned earlier that there's much more of a focus on sort of commodity retail as opposed to discretionary retail, and we think that'll continue. Some of the strongest specialty retail centers will always do well, but many of the ones that were sort of mid-market or lower upper market, they're in trouble, and we can see that already. More of a focus on experiential retail, and we're seeing a number of retailers do a good job. The easy ones are the guys that sell sporting goods. They can put in places to use their products, to test out their products, if you will, whether it's golf or tennis or whatever it might be. They're building spaces within their spaces to allow people to test their products. And we're seeing other retail tenants experiment with ideas in that regard. A lot of growth in cannabis, no surprise there. That'll continue for the foreseeable future. Location characteristics, very much a move towards freestanding and smaller prototypes, not just for fast food and quick service restaurants, but also for just general retail stores. A lot of tenants we used to talk to about for mall locations now want to be in their own independent pad location somewhere where there's good traffic and visibility. They're not willing to bet on the anchor tenant's ability to drive foot traffic past their storefront in a mall environment the way they were in the 80s and early 90s. QSR, a lot of transition in the fast food guys. We're looking at a number of prototypes, and many of which are now under construction, that will not have no interior dining. They'll be set up for delivery only. And some of them will be 4 drive-throughs, 2 for ordering from the menu, and 2 for pickup of online orders. And we've already looked at a few prototypes that have been built that way. And I think that's going to be a big trend going forward. Very much the online ordering has driven the change in that business. More and more retailers that we talk to, not the restaurant guys so much as the just general merchandise retailers and the specialty guys, they're really looking at their retail store as a billboard or a fulfillment center or showroom for their product. They expect people to go online and do a little bit of browsing and then come into their store. Interestingly enough, what we are seeing is the previous sort of direct-to-consumer retailer, in other words, the retailer that only had online presence, now opening stores and doing very well with the stores that they're opening. So we think growth in some of these retail concepts is going to come from the DTC, the direct-to-consumer guys that are moving to the brick and mortar environment. And the couple of things that are happening around this issue of being billboards and fulfillment centers and so on, what they're finding is that wherever they open a physical location, the result is that location ends up driving increased web traffic to their web retail or their online retail presence. So it's working pretty well for them. And it's an interesting transition, but it's definitely, it's very clear that that's the way to expand their sales, is by opening up more brick and mortar stores and using them to drive web traffic. The point of retail now, and we hear this term a lot, frictionless retail, which means if you're a retailer, no matter what kind of retailer you are, either DTC or brick and mortar, that you have to be able to offer all these things: buying online and paying in the store, picking up in the store, curbside pickup, and delivery. So all the brick and mortar guys are moving in this direction, the big national guys particularly. The regional mall values, they're going to continue to fall. And we're going to see a lot of those they just simply have to be something else. Neighborhood grocery anchored centers, if they're grocery anchored, and that's the key here, if they're grocery anchored by a strong regional player, the value of those has gone up. They have become a very desirable asset now. And there's a lot of money looking for those types of centers. If they're a neighborhood center without that grocery anchor, the opposite is true, as I mentioned earlier. Development opportunities here in Connecticut, we're going to see continued growth in apartments. So we simply have a lot of old stuff, and people want the newer upscale amenity-rich projects. It will be focused on markets where there's job growth as well. And of course, if you're close to a transit corridor or food and beverage, active food and beverage node or recreation node or area, those are great locations for apartments. A lot of activity in these markets that I've shown here. Industrial activity, again, near highways and where there's good labor pool and near other users like them. So for example, the Bradley development zone is a big driver of this kind of warehouse industrial logistics operation for all these reasons that we set out here. It has to be very much a research-based effort, using the typical stuff, demography and socioeconomic analysis, market analysis in terms of what the competitive alignment is. And that's very much an ongoing effort because things are changing quickly in a lot of these, in a lot of the criteria. Conventional planning really has to be looking at conversions of existing buildings or additions to existing buildings. That's really where there will be a lot of redevelopment opportunities here in Connecticut because of this older stock across all our sectors. So retail and office is going to be the focus of the conversions, of course, and municipalities should encourage any developer that's looking at acquiring something like that with the idea of redeveloping it. And communities should expect that they'll get asked to participate somehow with tax abatements or tax fixing agreements or tax increment financing or waivers of building permit fees or any number of things, because otherwise the numbers just don't make sense. The thing that will drive conversions is being able to buy these older functionally or market obsolete properties at a very low cost per square foot, and then be able to justify their conversion to an active sector. And in virtually everything we've looked at, and we do probably 60 or 70 market and financial feasibility projects a year easily. And everything we've looked at, the numbers don't work unless there's some concession from the municipality. Should be a lot of communication. We encourage that. And the money will go to communities and markets that support that kind of change. If the approach is, we'll wait on the sidelines and let the free market work this out, in all likelihood, you'll be sitting there looking at those buildings for a long time, foreseeable future. There's just such a low level of risk tolerance for that kind of project in markets where there is no population growth, that it just requires participation. So what do these things, get converted to? We've talked a little bit about this. Office to warehouse, industrial or residential or self-storage. Retail, anything on this list here. Retail can be fairly flexible. Usually this stuff, the retail locations particularly, are well located. They're fundamentally good sites from a locational analytics standpoint. So they represent an opportunity, and oftentimes the buildings that are on it are in the way. They have to become something else. Food and beverage, great growth area. I mean, the areas of growth we touched on a little bit are really food and beverage and arts and entertainment uses. That's the experiential component that I've mentioned a couple of times. And that's where we're going to see growth. We're just not going to see, as I've mentioned before, a lot of growth in traditional retail. In fact, we expect to see continued contraction in that, in the retail. Last mile logistics, sort of 1 mile delivery radius. That's a good conversion of retail for both the larger and the baby box. Bed Bath and Beyond's been closing locations. They're good opportunities to convert to be converted to last mile logistics. We'll continue to see some development of co-working and incubator accelerator spaces. The revenue models for those are tough. They're a good idea, but again, like I said in the previous slide, you got to be able to buy this stuff at such a low price. It makes it very tough to make this stuff work. Major regional mall properties, adding multifamily rental residential or apartments is a great idea. And I think we'll see a lot of that. And converting some of these malls to open air mixed use property is a good option. There is ongoing interest in the Connecticut markets from out of state for these reasons listed here. The pricing tends to be lower than they're coming from Dallas. They can buy things here on a lower basis, lower cost per square foot than what they would find available in Dallas. And they're attracted to that. They're also attracted to the stable markets that we have here and the lower competition. We do have a lot of older properties and they believe, especially in the apartment business, that they can pull a new project that they develop will pull residential users from the older 1980s vintage apartment building. But they've got to come in with liquidity if they're going to do this kind of stuff in this market, and a pretty detailed plan. So from a municipal standpoint, as I've sort of hinted at as we've gone along here, being proactive is really important if you want to capture the activity that is out there. Make contact with owners of buildings that you're concerned about. Don't just wait for them. Look at your zoning and permitting criteria and process. Many of you have heard me say that the ideal process is one which is swift. Your land use process is one which is swift, simple, and certain. Happy to talk that over with you in more detail if we had time at some point. And I mentioned the need for incentives. The templates are changing for all of the stuff that we look at in commercial property. What we saw done 10 years ago, 5 years ago even, is changing. And we just have to, as municipalities, we have to change with them. And that means we got to be flexible in a variety of fronts. So just in summary here, with some assumptions, as long as there isn't increased geopolitical instability in some of these areas that I've listed, we don't get another pandemic or something similar. Interest rate hikes that are expected don't come in differently than we're thinking. No energy crisis and no increase in the key economic indicators. If all those stay stable, it's actually a pretty good time, particularly for owners of some of the properties to sell quality assets. There are investors out there still looking to buy stable quality assets in stable quality markets. And there are a number of those here in Connecticut. The bid-ask gap that I referred to earlier is narrowing. And look, the reality is there's just an enormous amount of capital waiting to be deployed, and it will not sit on the sidelines. We're already seeing that. It's just not going to sit on the sidelines and wait until we see more market certainty. It simply can't. It'll be tougher. The financing criteria and the investment criteria will definitely be tougher, but it'll come into the market and they will buy quality assets in quality markets. We are going to see, as I said, this bid-ask gap, and that'll create opportunities for redevelopment as some of the sellers get a sense of what market values really are and put their property out there at a reasonable cost. There is emerging demand for new products and services. As I said, we're seeing direct to consumer come into brick and mortar. Capital definitely looking for opportunities and ideas. And, I've been doing this all my life. I've lived through the savings and loan crisis and the global financial crisis and a series of other slowdowns, total of 7. So my view is a little philosophical. I don't see it as really the end of the world by any means. It's simply the end of another cycle. And the important thing is companies that go into this cycle with liquidity and a track record, there will be enormous opportunity for them in this new environment. And they are out there and they know they are waiting to some degree. Some of them are coming in already, but they know there is going to be great opportunity. So as that starts to occur in your community, encourage it. And to the degree you can, work with it. So I'll borrow from Charles Dickens and end there, and we'll take a few questions for a few minutes. So Paige, are you up, or Kevin?
Sounds good, Mike. Great job. As expected, you definitely have an optimistic viewpoint, which is a good one to have. So at this point, we'll open up. We have a few minutes for questions. You can either unmute yourself and jump in. I see Dan's got his hand raised. Dan Smolnik, why don't you go ahead and start us off?
Thanks, Kevin. I feel like I should match you here by putting these on so that we're more on the team. It's also so I can read my notes. Mike, some very good points and some very thoughtful stuff. I sit on the Hamden Economic Development Commission. We're down by New Haven, and we're for most intents we're caught up in the New Haven urban facility here. And I think a question that occurs or that may occur to a lot of municipalities is dealing with the housing shortage that you very astutely brought up. A lot of towns are dealing with it on a very acute level, and that brings to mind all kinds of interesting discussion points, not the least of which is multifamily, which you touched on several times. And I'm going to ask you to sort of polish your crystal ball here in a second. Really just to contribute to the ongoing dialogue. We see a lot of cap rate compression in multifamily with B and C, but with A multifamily, a lot less compression as I read the data. And the permitting activity for multifamily is up. Even a 3, 4, 5 bedroom, as I track the data, is up in multifamily. At least the permitting activity. We'll leave completion rates aside for a second. Given the sort of demand, the existing inventory, which in some cases is really dead weight on some towns, do you see the answer in the local answer as sort of in zoning, in public-private partnerships, in incentives, as a pure play, as among any of those, or do you see it more as a sort of combination approach to address this? We're not able to simply make the B and C multifamily interesting just because of the costs involved. A lot of it is 60s and 70s construction. It's just not going to fly. But getting a property built is sometimes a strategic challenge. So I'd kind of put it to you, put on your philosophy hat for a second. I'd love to hear what you think.
I should mention that I think it's the May session, Kevin, is that right, that we're doing is going to be on housing and
Sorry, you got muted there, Mike.
Yeah.
Yes, to answer your question, Mike, yes, May is the housing strategies focus.
Right. So, but let me give you a quick response if I can, Dan. You're right to talk about or to be worried about some of the 60s and 70s vintage apartment buildings. And I don't even think it's that old. I mean, an 80s vintage property is now 40 years old, and it has the 40-year-old problems, and there's just no getting around that. Some of that stuff, I mean, you're talking about all new mechanical, electrical, all new kitchens, all new bathrooms. If it's got exterior stairways, a lot of those stairways have deteriorated badly and the stairways have to be replaced. I mean, all kinds of issues. We looked at one just the other day that's in an absolutely terrific location, but it's a early 1980s vintage property, with all that dark wood on it, and all that dark wood is literally rotting away. And I mean, the cost of going in and doing the things that I just listed is prohibitive. They will never get enough rent to make it make sense. What I think has to happen, unfortunately, in a case like that one is they're going to have to, somebody's going to have to buy it, empty it out, tear it down and build something new. There's just no economic answer. And this is where we run up against people asking us, I had somebody ask me this a few years. They were quite angry at me because I made a similar comment, and they said, "Are you telling me depreciation is real?" I thought it was an accounting entry. And I said, no, it's, buildings are not forever structures. They have a life. And usually when you get beyond 50 years, particularly, depending on what kind of building it is, it's at the end of its life. I mean, if you think some of this stuff built in the 60s and 70s is going to see it last for 100 years, like some of the buildings built years ago, it's not in the cards. It is not going to happen. So what's the role of a municipality in that? I mean, I think being honest about what's there, and B, starting to respond with public policy responses that at least will help people owners deal with those kinds of issues. Some of this stuff can be renovated and made relevant again, but a lot of it simply it's an end game. I mean, again, we've done over 300 financial feasibility analyses in the last 3 years, I guess, and many of those on the multifamily rental residential conclude that spending the kinds of millions that it would take to make it market relevant makes 0 sense from an economic standpoint. And it really has to go away and either be turned into a new property or be something else, unfortunately. Look, if you've got a 95, 2000 property, a 20-year-old property, I think it would be good to get into a dialogue with the owner of that property and get a sense of where they're going with it and whether they're going to reinvest, because that's the time to reinvest. If they can get it at 20 years and do it then. The problem we see with a lot of these non-institutional owners is they're used to just taking money out of it. They put enough in it to keep the parking lot paved, and that's about it. And that's unfortunate. The institutional owners, the pension fund owners, are different. It really depends on a lot of factors, but you're right to be concerned about the properties that you described, and we'll hopefully have a little more robust conversation in May.
Yes, that's correct. We'll talk on that topic in May. We're going to just have time for one, maybe two more. I got a couple questions come in from Julie Nash of Milford. She says, I hear biotech all the time. Does the demand match the branding? And then her second question is cannabis a short-lived success, roughly 10 years? When feds legalize, then the big guys will take over, the Philip Morrises, et cetera. So if you want to tackle one or both of those.
Yeah, biotech is, we have this, we struggle with the same definitions, biotech and life sciences. We asked, a group of people to define life sciences, and they all work in the industry, and we got 5 different definitions. So, I think any sort of non-manufacturing sort of technology oriented use, whether that is medical technology or some other form of technology, we consider that sort of biotech, life science kind of uses. And no question that there is growth in that sector. The real issue, if you're a municipality, is to be looking at who's behind that growth. The strength of those companies really depends on their access to capital over a longer period of time. And unfortunately, we've seen communities that have made significant bets, helping to attract biotech and life science developments, only to find out that, the technology that was being developed turned out not to be as profitable, and it got closed down after 5 or 6 or 7 years. So it can be, if it's a startup, it can be risky. Look at the underlying support, who's behind it from a capital source standpoint. If it's an existing non-startup use run by a larger company with a track record, I mean, those are great jobs. They're great users. They build out expensive buildings and pay a lot of property taxes and pay a lot of they have a lot of high-paying jobs. So, but dive underneath the track record and who's behind it. What was the second question again?
Kevin, you're muted. I'll go ahead and read it. Is cannabis a short-lived success?
Cannabis, right.
Roughly 10 years when feds legalize and the big guys take over. I think that's going to be our last question.
Yeah, I think there's a good reason to be a little bit skeptical as to where cannabis is going to lead us on all this. It's something that's in our view has become very overheated. The people that are involved in it, in many cases, are similar to the people I talked about a minute ago with respect to startups. They're all excited about it. They come in with a lot of capital, but you look behind it and there's not much track record for operating those kinds of operations. So I think it'll be the ones that have track record and have access to capital that will survive this normal sort of tremendous growth as cannabis develops, and then the contraction of that back to sort of expected normal levels following that. and it'll be the guys with the capital and the track record that survive that. So it's worth looking at, again, who's the sponsor, what's their track record. I do think that, Julie's question about the becoming federalized and the big national guys coming in. I mean, that's an definite possibility that wouldn't surprise us at all, but I do think it's some ways off. We don't think the feds have really any desire to make it legal at a federal level. And we don't see that changing probably for quite a while. I think the feds are quite happy to let the states figure it out and leave them alone. So as long as that continues, we'll see the same sort of investor groups coming into it that have been doing it so far.
Well, with that, thank you very much, Mike, for this industry overview. We really appreciate it. And as we mentioned, Mike and the team will be back for 2 more sessions. The next one that he's doing is the 19th of April. It's going to be on Back to the Basics, sort of an economic development 101, looking at some, tried and true practices of economic development. Again, that's 1 to 2 on the 19th. You can register for that at the CEDAS website. But coming up before that, we do have best practices info session number 1. We're going to offer this twice for the best practices certification CEDAS program that we're encouraging. The application is open now. We're taking those applications now, but if you want to tune in for an info session on it, it's March 23rd from 1 to 2, the same time, and then it's going to be offered again April 6th. So we have two versions, 2 chances to catch that session. So I want to give thanks to Mike again, to Danielle from CCM for helping us out with the webinar, and to all of you for tuning in. This recording of this will be made and available, and the deck will be sent out to everyone. And lastly, if you had any follow-up questions, I did put Mike's email in the chat. I hope he doesn't mind. You can follow up with him directly on that.
Yeah, that's fine. Nice to see everyone.
Thanks, Mike.
Thank you. Have a good day, everybody.